Hey everyone, I'm Giovanna here with Hassan, and today we're tackling a topic that's often a make or break moment for early stage companies raising capital. We'll be diving deep on how to secure your first 25,000 from angel investors. One of the first questions I think a lot of entrepreneurs have when they start thinking about funding is, do you actually need capital to start a business? What's your take on this, especially for tech companies?
Well, you do need capital in the journey of your company to be a big, successful company. Pretty much every company that's been big or successful has had to do investments. It has to have built a team. It has to have, do some marketing, and all of these things require money. And so you sort of do need capital. But the real problem is, the real challenge is solving that chicken and egg problem of how much capital do you need to get to that next step in your business that unlocks the next chunk of capital and that whole process. uh, you know, like some interesting historical information is that, when HP began, it started with just $538 in 1938, which like for today's money is about $11,460. But not a lot of money, but still some money required. And the reason is that, if you think about building out your uh, startup idea or building out an app that you might have, it takes between $80,000 to up to $250,000, so $250,000 to get it all built out, and that requires money. So what I would say to founders is think a bit about why you need the funding. What's your process like? Do you need to build an app? Do you need to build? Do you need to do marketing? And then think about what kind of traction can you get before capital? So like that would mean running sort of a survey, right? Like reaching out to the kind of people that you think you would want to sell this app or service or product to, and just getting some kind of validation from that about whether they want it or not. All of this is helpful for just both from a fundraising perspective, but more so from your own belief perspective, because the first thing a founder needs is conviction about what they're going to spend the next years of their life working on is something that's going to be fruitful, or at least is solving a real problem. So as soon as you can get that initial validation solved around demand, and you have conviction on your end, that's a good place to then start going out and raising some capital, which you do need. And what you need the capital for is basically building a minimum viable product, which is sort of the simplest version of that, of your idea or your product that you can put out there, and it validates what you are thinking. So if you let's say start with a survey or start with some initial interviews with folks who you're trying to solve a problem for, you sort of want to validate also that your solution is able to do that. So you figure out there's a problem. So that's where the MVP comes in, is that you use some amount of capital to build an MVP, which is the minimum viable product, and that validates that your approach towards that solution is working, uh, and that becomes sort of the first step of building your startup.
All right, early stage tech startups face a chicken and egg problem, but an MVP helps validate the idea and attract initial funding without needing massive capital. Can you tell us what exactly are investors and what do they do? Who typically fits in the role of a potential angel investor?
So an angel investor could be anybody, right? Like anybody with money and with the ability to invest in your startup. They might not necessarily even think of themselves as an angel investor. The big difference is that angel investors are high net worth individuals or folks that might have a really nice job, like think a doctor or a lawyer who has money and can think about spending at least a couple of $1,000s in a startup idea without facing sort of financial ruin if that startup doesn't really work out. And these folks are significantly different from venture capitalists who are pooling other people's funding and other people's money and are in the business of investment. These angel investors are actually just folks who are living their life. They could be like former successful entrepreneurs. They could be people who have inherited some money. There could be people who have a really strong career or have, are professionals in industries like finance or medical or, law, and who have built out some financial cushion and resources on their end. And they're interested in investing in ideas that connect to them. They might be interested in investing in people that have a relationship with them. So a lot of what angel investing often comes down to is your network. So how can you connect with these people? Even celebrities have done angel investment, like Ryan Reynolds has done angel investment. So this is something that anybody with some resources can be doing, or that could be convinced into doing for your startup if you're a startup founder. Uh, and the main thing is that these folks aren't really looking for and only a purely financial angle, a lot of angel investors are often looking into how well do they connect with the idea, how well do they connect with the founder, like is this something that mission aligns with what they want to see in the world. For example, somebody might be uh, a doctor who cares a lot about music. And so the startup idea that connects on music on an emotional level with that doctor, they might not be very financially savvy to think about how that investment plays out for them from a returns perspective. But that's probably not why they're doing that investment in the first place. They're really interested in the idea and want to support the founder, and they'll invest some money as an angel investor to make that vision happen and make it into a reality.
So, angel investors aren't just like a source of money, but they're also a source of experience, a source of strategic support to help growth in the business. How would we find these angel investors?
So this is largely about networking and sort of leveraging the right platform. So firstly, start with your immediate network. Like most people uh, will have access to an angel investor. They might just not be thinking about those folks like an angel investor. So start with your network, your friends, your family, former colleagues, mentors, your boss at work. Think about alumni from your university, other people that you might have looked up to just professionally. Anybody who is somewhat successful in their career is basically a potential angel investor for you. And so that's somebody that you want to connect with. And if there's somebody that you already have a past relationship with, that really just makes the trust factor of it a lot easier. And those folks are more willing to invest in your success as well. There's also websites like AngelList and Gus, which are online platforms that you can connect with accredited investors. There's angel groups. So a lot of folks who are more regular angel investors that might be doing this as a hobby or even as sort of a way of diversifying their investments will join angel groups like the Angel Capital Association or the Tech Coast Angels just to organize their investments. Startup accelerators and incubators are often another helpful place. They have their own network of angel investors and can provide excellent introductions. Programs like Y Combinator or Techstars, even like your university's entrepreneurship or career program, these are all places that could open doors to angel investors. And then there's just a lot of networking and meeting folks. So you could literally reach out to like your initial chunk of people in your network or professionals and then ask them to make more introductions for you. So because every single person that you talk to probably knows 10 other prospective people like them or other angel investors. So you can think about building a spider web of supporters or angels that not all of them are going to invest in your company, but your job as a founder is actually to talk to 100 of these folks and unfortunately hear no from 90 of them so that you can get a check from one or two of them. And that's just the process. So you just have to go through that. And each of these people are looking at you as a founder and judging your own conviction and your idea. And like most founders, not everybody is a good fit, but when you do find a right investor, that can really help your journey and help your startup because these folks can often become long-term mentors as well.
Meet angel investors with the intention and focus on building relationships, not just pitching. That's the deal. So, when a founder is looking to raise their first capital from angels, how much should they typically aim for?
So the big point is how much do you need to get to that next milestone? Uh, Now there's lots of industry averages and standards, and we can come to that. But the first thing that an angel is looking at when you approach them is, okay, I give you this money, who else is giving you money, and then when all of us are giving you money, what can you do with this money, and is that going to put you in a better position in the business in terms of being able to, I don't know, get more revenue, invest, raise more venture capital in the future, maybe bring in institutional investors which are like venture capital funds. What does my angel investment help your business achieve? That's the key bigger conceptual point. Typically, when we look at the data, angel investors invest between 25,000 to 100,000 per investor, but this is like the classic Silicon Valley startup. So if you're looking at raising from your own network, even like a $2,500 check or a $5,000 check can make a lot of difference, especially if you can get more folks involved. So it sort of depends on what your ability to raise is. If you're a successful mid-career professional who's probably been part of the founding team for a couple of successful startups, you might be able to raise larger checks. If you're a college grad looking to launch your first company straight out of school, folks might not be willing to write you a 100K check, but you can get a couple of $1,000s from many people and use that to build an MVP that can validate demand and put you in that position further on. round size, it depends again on the company where you are based and what your costs are. Like if you're looking to hire a team in Silicon Valley, the cost of hiring your engineering team is going to be a lot higher, and so you're going to have to raise a lot more money, and you're going to be in a better position to raise that money because you're over there. So it depends on your ecosystem. But the average angel funding round can be between $250,000 to $1 million, and all of this money is again tied to a specific milestone. So, what you can prove that you can do with the money and how it can help your startup's journey in the long run, that's the important part. So, in terms of how much to raise, just focus back about, think about what you need, where are you based, what will that money allow you to do, how much can you actually raise. So sometimes, most founders actually don't have the privilege of being able to pick a number and getting that funding. So they have to think about, all right, I can raise $20,000 if I reach out to these people, and what can I do with that money now? And then you can structure a raise or an angel round and then do that. And at the end of that milestone level, you're probably better positioned to raise that next chunk of capital because you're further along in that journey than you were before.
So, on average, we can expect to raise around $25,000 to $100,000, but based on clear milestones to show how the funds will drive progress. How do you structure an angel investment round? Are there legal documents or frameworks that entrepreneurs should be aware of?
Yeah, so a great thing that every entrepreneur should read about is the SAFE, which is a document by Y Combinator, one of the biggest and most successful accelerators called SAFE, and it's short for Simple Agreement for Future Equity. It's popular because when you're looking to raise funding from angel investors, there's a real hard question about valuing your business, like how valuable is this company, and safes allow that process to be basically kicked down the road. And instead of angel investors determining that valuation, they can come in on a discount from a future valuation that an institutional investor like a venture capital might put on the business. So let's say you have this great idea for an app around music, and you go and reach out to your network, you reach out to everybody that you know who could write you a $2,000, $3,000 check, and you get 10 of these folks to write you some initial angel investment checks into your business. Now you want to figure out how to do the legal work, but you don't know how to value your business. You don't know how to deal with a lot of that, or you might not be able to make those decisions right now, and your angels are not in a position to make those decisions. So you could do a safe agreement with them and say, after, give me the money now. In the future, I'm going to go raise money from venture capitalists who will help solve the valuation equation and all of those things. And because you're coming in early, you will get a 30% discount on the valuation the venture capitalist is getting. And so these structures allow you to keep the legal overhead really low. Like these are really great templates that you can adjust. You don't have to, you should get a lawyer to review everything, but you don't have to have a lawyer do a custom deal every time you're looking to raise a couple of $1,000s. And this can be really helpful for early stage companies. And what we're seeing in the industry now is that even seed stage rounds for a couple of $1 million are being done through safe rounds, safe documents, just because it allows a lot of the early work to get done without large legal overhead. And then eventually, when there is a priced round of funding by an institutional venture investor, all of these safe documents convert into real shares in your business for these investors. So they're also taken care of, and you as a founder don't have to worry about a lot. And you can just focus on proving out the traction for your business.
So, safes offer simplicity and flexibility, especially when a company's valuation is still uncertain. But as with any investment, there are still risks. What are some of the potential downsides or risks associated with taking on angel investors?
So while angel investors can be fantastic partners, there are potential downsides as well. The main thing is who that angel is, right? So for example, what you should not do is take all of your parents' saving and retirement funds and invest it into your startup as an angel investment, because that's a recipe for both really unhappy parents and probably not the best decision making on your end, signaling to other future investors. So you want to think about the relationships involved. So the best chance of getting angel in funding is going to be from people that are in your network. But you also don't want to destroy your network by promising them the moon. And so you want to be honest and be fair about that disclosure and take as much investment that, in the worst case scenario, doesn't really like cause serious harm to those folks that you're raising capital from, but also puts them in a position to benefit from the upside of your idea working out. Because at one level you do believe in your idea to be able to pursue this, and you should believe in it enough to ask other people to invest in it. So think about those relationships. Then also, angel investors are often people who are looking to not only give you some money, but also give you a lot of advice. And so they're looking to be more hands-on than venture capitalists. And this can be, if you get a lot of these angels that are really have a lot of opinions and want to talk to you every day about your business, so all of a sudden you can look like an entrepreneur spending a couple of hours every day just talking to your investors and keeping them updated instead of focusing that energy onto your real business and into getting sales and traction for your business. So think about the kind of investors you're raising from and the time commitment and setting up the expectations well. Uh, there's also people who don't really understand how this works, so they might there's a degree of risk to this, and all an angel investor should be aware of that risk. But there might be some folks who give you some money and then expect you to behave like an employee, or like ask you to be like following their vision on your company instead of your vision on your company. So just sort of think through all of these things and think through who you're raising money from. There's the aspect of dilution. So you might be giving up 10 to 30% of your company to angels, depending on how much you raise and how the round is priced and structured. But you need the funding to get your company to be valuable in any way. So it's always best to think about this holistically, because in the end, if you believe in your vision and it works out in the long run, you're going to be better off and your angel investors are going to be better off. But you just want to make sure that you don't do anything with your angel investors, or you don't raise from folks that will hamper your ability to build your vision and execute on your startup.
So what's important is finding the right angel, not just any angel. Can you share with us a real world example of a company that truly benefited from early angel investment and went on to achieve significant success?
Yeah, so Airbnb is a great example. So, we see them as a global hospitality giant right now. The company's been valued over $100 billion, but in 2008, it was a struggling idea by three founders, and they had no idea how to make the business work. They were literally selling cereal to be able to stay afloat and pay for their bills. And in 2009, they got some angel funding from Y Combinator through Paul Graham, who believed in their idea and gave them $20,000 for a 6% stake in their company as seed money. This seed money allowed them to build out their idea more, get feedback, and get some validation, which allowed them later on to raise more than $600,000 from seed investors and early VCs, including Sequoia Capital, who were now willing to bet on this founder because Y Combinator had bet on it. And again, Paul Graham and Y Combinator did really well on that investment, because they invested $20,000 and got 6% of a company that is now worth $100 billion. So it was a pretty good investment. But that turned out to be really a case of where these founders were just struggling and struggling, and nobody was talking to them or giving them investment, and they were facing rejection again and again. But they persisted, and it's actually persistence can be one of the biggest things that can drive a startup success. So angel investors are important, and the best way to get them is to not give up and trying to get them, and actually keep iterating and hoping for that light at the end of the tunnel.
I'm a founder and I'm looking for an angel investor, but I also really need mentorship and critical tech expertise to build my product. How can HBF Venture Accelerator help bridge this gap and help me raise angel investment?
Great question. So we want to make sure that you are well placed to be building a long-term business in the long term. And the way we do that is we help validate your business by building an MVP and investing $50,000 into the development cost of that MVP and helping you get traction. Now, we ask for a $25,000 copay on your end, and an angel investors could be a good place for you to sort of share that risk with angel investors. And how we would sort of guide you around doing that is, think from it from an angel investor's perspective, right? What they are unsure about right now is that you as a founder, can you actually build this idea? And are there going to be other people who are willing to invest in your business? So you can actually signal both of those two things by partnering with our accelerator by saying, look, I have this accelerator ready with me. They're willing to invest $50,000 into my startup idea. I'm willing to invest $5,000 of my own saving into this idea. And so we only need $20,000 from you or from a group of 5 angel investors. We divide that cost up. And this is when you do give me this money, we will be partnering with this accelerator to build the MVP. So we have a strong development partner that has built many projects and many products for different startups already. And so they have that expertise from engineers and designers and product managers, and they can help bring that vision to life. And they're willing to invest in my vision as well. So that way, when you talk to an angel investor, you can de-risk your startup or your company by making it sort of come across as something that already has attraction from an accelerator partner, and that's how we would go about that. We'll also help you around working through your pitch and how to present your idea and giving you feedback around how to network and how to connect with angels and guide you throughout that whole process of angel investment. But the biggest things we can, I think, help you with is when giving you the ability to go to angels and say that I already have $50,000 committed into building my product, and I have a partner who can build my vision and build my product for me.
It's sounding to me like the HBF Venture Accelerator helps founders take that crucial next step, building out their MVP, getting ready for investors. If you found value in this episode, make sure to subscribe or follow, leave a comment, like, or share with a friend.